to you. Everybody will hang up if I do that. You don't want to hear it.
Let's do it, Jenny. Let's do it.
No, no.
Keep them coming back.
It won't be with my singing.
All right, well, we'll go ahead and let everybody jump into the room here, and then we've got what I think as a numbers nerd, a lot of awesome information, but we'll try to run through it quickly. So for those of you that can only handle this in short spurts, we'll get the information that you need. So yeah, let's give it a couple minutes here. We had a lot of RSVPs, so we'll let people roll in, and I'm assuming we're a group of real estate agents, so the biggest number will be in the 5 to 10 minutes after 1, but we won't make everybody who's on time suffer that long.
Yeah, that's awesome.
Maybe a minute or two here. Yeah, Dana, I'm coming for you, by the way. I don't know if you saw my my post in the Facebook group internally, but since you decided to do your market update this week too, I figured this was a competition. So
well, yours might be better than mine because I'm under the weather, unfortunately.
Yeah, reasons are results, Dana. Reasons are results.
I know. I hear you, Troy. I'm looking forward to stealing some of your stuff.
Dana, I'm looking forward to your call next week with Ken Pozak on there. He's like one of our top referral partners.
Oh, Ken's the best.
Yeah.
Guys. Yeah, that's gonna be great, Chris. I hope you please be on. It's gonna be awesome.
Yeah, no, we do a lot of business with Ken Pozak group.
Yeah, that's gonna be an idea that Gary actually gave us in the mastermind last month, which was to take people and have them each share 10 minutes of a hack to make $1 million. So it'll be a good one.
Yeah, he's great. His story's really good.
He is. He's awesome.
Yeah.
Cool. All right, I'm going to give us till 1:04, and then everybody that's coming in later is just going to be coming in later in the middle of it. So, all right, I'm going to share my screen real quick just to let you guys kind of know what's going on, and then I'm going to pop it over to Chris here in just a second. All right, well, it looks like at least the flow of new people has slowed a little bit, so I'm going to go ahead and get started. I super appreciate all you guys jumping on today. Like I said at the beginning, we have a lot of really great information and that we're excited to hear. I had a special guest, which I told Chris is probably the reason why all you guys are here. Get to hear a different voice with some good info, but lots of good data coming in. Well, good or bad, depending on your outlook on things. But the goal today is to not only share data, but the thing I want you guys to take away from this is really how to have conversations. I mean, if your conversations are anything like my conversations over the last month or two, pretty much everybody that I talk to is asking me, what's happening with the market and then what's going to happen with the market. And so although none of us have a crystal ball, I think looking back at history is always the best guide that we can have in order to be able to answer that question. And I believe that we're shifting from a market where all you had to do was have a real estate license and be able to fog a mirror into a time where our clients are going to be looking for people who actually can guide them and give them valuable information to make what, to be honest with you, are really big decisions for most people. And so I think your ability to be the local economist of choice for your clients, which I stole that phrase from Gary Keller, but it is going to be crucial, at least over the next 6 to 12 to maybe 24 months, as we are in the reality is an economically uncertain time. And so I think you'll be able to gain at least a few pieces of business per year just through being able to know this stuff. And it's going to go from, again, just being able to fog a mirror to looking for somebody that actually knows what they're doing. So with that being said, quick kind of summary of what we're going to be looking at. We're going to have Chris jump on, and I really appreciate him jumping on. I think he has a really unique perspective and also very informed perspective. on interest rates and just really the overall impact of a potential recession on the mortgage and real estate industry. And then also look at inventory and selling trends nationally, and then also jump into how I present them locally. Obviously, if you're not in the Columbus market, you'll have to go get your own specifics, but hopefully that's helpful. And then talk a little bit more about inflation and its impact on interest rates and also prices, both currently and historically. And if we have time, we'll go through affordability and inventory. So with that being said, I'm actually going to let Chris share his screen. Chris, I think you can just steal it from me. But if not, I stop sharing.
Yeah, I think so here. Sorry. I was gonna say good morning, but good afternoon, everyone. Thanks for letting me hop on here real quick. And Troy, thanks for inviting me. You know, we have a responsibility to our clients and everybody we have relationships with in this industry. There's currently a huge narrative gap. There's what they're hearing in the news, there's a gap, and there's what they're actually feeling from what's happening. We're the professionals that they count on. We're the ones that need to fill that narrative gap and help them understand what's currently going on in the market, not what someone else's opinion of it is. So I use a lot of historical data like Troy. That's probably why Troy and I get along so well, because we geek out over this stuff all the time. So I've broken it down in more layman's terms, but should be some stuff for you to take away today that you can have that conversation with in the short term with anybody who's interested in buying a home. I'm going to share my screen real quick. Okay, so the first thing I want to talk about is mortgage rates during a recession. Now, you see they track the data all the way back to 1972, and it's funny because Troy had asked me on our call the other day what I thought about interest rates compared to now, compared to what happened in the 70s and 80s. But if you can look, you can see historically, every time there's been a recession, interest rates have gone down. 16 to 11.75, 18 to 13%. 11 to 8.75, 7.375 to 6.75, and so on. So you can see, I'm sorry, I need to move something here. You guys over here. You can see as recently, the most recent recession we had was in 2020. Now it was very short-lived, but you see interest, you can also see the data where interest rates went from 3.75 to 2.75. Now, most people think recession and get these fears. Oh no, mortgage rates are going to go through the roof. Historical data proves that that's not the case. Now, when you see the Fed raise rates later this week, that has zero to do with mortgage rates. That's your short-term rates, your car loans, your credit cards, your equity lines on your homes, but not your actual mortgage rates. Now, what happens during housing during a recession? I love this chart. So you can see tracking back to 1960, the dark lines are recession. Every time there has been a recession, except once, the price of homes have increased. They've leveled out a little bit, but there still has been an increase historically. Now, most of us know what happened here in 2008, 2010. That was categorized as a housing recession, not the type of recession we're facing right now. You know, we had properties, we were oversold. We had too many properties on the market. We had a housing recession, which caused the actual market to deteriorate as far as values were concerned. We have no fear of that moving forward. As you can see, we're on a way upward trend, and we'll see the same as we move into this next market. Now, here's a really cool chart as well. Housing demand basing off of household formations. Now, what that means is people who are buying homes as a first-time home buyer, or somebody who's leaving, currently renting, buying a home, not someone who's selling a home and buying a home. Okay, and you can look at all the historical data over the years. Where we're at currently, we're at 1.417 million shy of where we need to be. Okay, so we have 1.471 million shy of where we need to be in the current market. Now, obviously, if you're watching the news or getting more information from other outlets, people who aren't dialed into this process or understand what's really happening, the information you're getting is to whatever agenda that may be or whatever. They're not educated enough to this exactly what's going on. So I want to share one more slide here with you real quick.
So hey, Chris, let me stop you real quick though on that, because I think what I've learned is just sharing the data. What we want to get through today is, so if I asked you what does that mean? What does that mean? So we're 1.4 million household formations short. Like, what does that mean to the market?
So I'll show you based off of new housing supply. Here's some of the data that'll show you the differences with there. Okay, so housing starts, there's 1.5 million housing starts. This is where the 1.4 million comes into play, Troy, sorry. Annually, they just, oops, sorry guys. Annually, we destroy about 100,000 homes, tear down to build. Household formations of 1.4 million. Again, household formations, we used to call this, we actually, if you look back, the average home buyer is 33 years old. The first time home buyer is 33 years old. So they use the charts 33 years ago to figure out how many households are going to be needed moving forward. Based off
basically the number of people that were born 33 years ago was 1.4 million.
The housing formations. So these can be multiple, they're not just individuals, Troy. So they used to call it just birthing rate, but now they've done the housing formations because you know, if you're a single buyer, you'll be housing formation, but you have a family of an apartment looking to buy, that could be the same as well. But this is where the numbers get interesting. Maybe. Sorry, guys. I'm the worst at this stuff. I usually have someone else doing this for me here. So
Chris.
All right.
The up
So
arrow.
I know, right?
The up arrow on your keyboard.
Yep, I'm there. So housing starts completed 1.5 million, destroyed annually 100K, total supply 1.3 million, household formations of 1.4. So we're still at a deficit of 50,000 homes. So when people say, are we going to have a housing bubble? Is there a bubble? There's no bubble coming. The bubble we had previously was based off of in 06, 7, and 8. If you go back 33 years, we had a massive decline in birthing rates. We had way more homes built than we had people. Plus we had, unfortunately, my industry was giving everybody money that even just wanted to have money. Didn't matter if they qualified or not. So those things have all been corrected. Here's something I want to share you real quick that comes from a news outlet that says every few years we're in trouble. So if you look, if you'd have taken guidance from somebody who was not in the industry and didn't understand what was happening, in 2015, housing today, a bubble larger than 2006. So if you bought a $300,000 house in 2015, the average appreciation is 5.1. It'd been worth 315. 2016, we're in a new housing bubble, 5.4% appreciation, another 17,000. The home's worth at 332. November 2017, homeownership doesn't build wealth, study finds. I find that very interesting. 6.1% appreciation, another 20,000, 353,000 value. September of 2018, it's better to rent than buy in today's market. Another 4.1% appreciation moves you up to 367,000. 2019, the housing market is about to shift in a bad way for buyers. 4% appreciation, $382,000 in value now. 2019, next year will be hard on the housing market, especially in these big cities. 16% appreciation nationally, 443,000 in value. July 2021, housing boom is over as new home sales fall to pandemic low. 18% appreciation nationally, $523,000 in value. So if you would have followed the information, not from a professional like everyone on this call, you would have missed out in $223,000 in appreciation. And I'm trying to figure out how that does not build wealth for your family.
That's awesome.
Hopefully that answers some of those questions. And I know I didn't have a lot of time to get on here today. Troy knows me, I could go on for a couple hours, but
what's your next slide there? Amplify your message.
So talks about what to do in the market as far as video branding. This is for a different presentation I had, but sorry, yesterday I put this together. So it really comes down to what we're seeing happen in the current market for us on the lending side is we are seeing some changes in what qualifications are required. So we're seeing some tightening in credit, which is a good thing. Because in markets like this, generally what happened in the past is credit would loosen up a little bit and then we'd get ourselves into some trouble, right? You'd increase debt ratios, that type of stuff. So we're seeing some tightening a little bit there. But what we're expecting to have happen is we think we'll be in a true recession by the end of the third quarter. And we'll see rates start to come back in the fourth quarter, start to lower. So that's what we're predicting right now based on all the historical data we have. And a recession is actually a good thing for the housing industry. Even though a lot of people don't, you hear the word recession, it's like, oh no, what am I going to do? Well, sell houses, rates are going to be low, and you're going to be able to keep moving forward.
Cool. Well, Chris, I appreciate you jumping on. Well, I think Chris might stick around for a little bit, but because he might have to leave before the end, does anybody have any questions at all for Chris on interest rates or the data about recessions and housing, any of that stuff? You can either type it in the chat or unmute.
I'd just like to say something that Chris has said that I'm now making a part of my conversation with people is marry the house and date the rate. And I think when you can explain to people, they see this house they love. Anyway, I just love that. And I've been using it, Chris.
Awesome. Yeah. And, we had a call this morning with several loan officers, and we were talking about understanding what that annual review looks like. So we go back to our borrowers every year and we look at their financial situation and see where they're at. Because the house is a wealth building tool. And if you don't have somebody who's helping your clients that way, then you need to find someone who does. It's more than just putting a 30-year fixed rate on a piece of paper and hoping things work out. It is a huge tool to help them build financial wealth and financial freedom for their family. And you need to make sure you have a partner who's doing that for you.
Yeah, that's awesome. So Chris, why don't you jump down to your slide there? And I think we have people from across the country on this call. So tell them where you're at, what you do, and what states you currently work in.
All right. So I'm Chris Welton. I'm the VP of Sales at Certified Mortgage Planners. And I'm currently in Florida and Hawaii, but in the next 90 days, we'll be in Kentucky, Indiana, Ohio, Colorado. We're in Colorado too now. We just got that a couple weeks ago. Kentucky, Indiana, Ohio, South Carolina, Tennessee, and Georgia will all be by the fourth quarter.
Okay, awesome.
But if you have any questions, you can always reach me at this number or via email. I'm happy to set up a call and I love to educate people and help with this. And I really appreciate the opportunity on the call, Troy.
Yeah, thank you.
Troy, I've got a question for Chris. Just, is it normal that when interest rates go up, the banks react, but then it seems as though they're all fighting for that mortgage dollar, that they all then become competitive and then the next few weeks and lower them? Is that normal, or what is your take on that?
Yeah. So all mortgage rates are based off of mortgage-backed securities, right? So all the mortgage rates are securitized and then sold on a secondary market. But what happens when you have a big movement, right? When you have a big movement in the rates, and we start looking at the banks start looking at data like, okay, there's going to be a refi coming. What happens is you get what's called margin compression. What I mean by that is the higher the rate doesn't pay a higher yield to the person selling the rate. They kind of lock you in at a certain point. So a lot of the banks, instead of selling those, securitizing those loans and selling them, they'll retain them and service them and put a different product in and put it at a lower rate, more competitive for short term, because they want to protect themselves or hedge themselves on the refund the refi. So you're going to see a lot of that as we've been in volatile times right now. The best thing that can happen for us is to be able to to stabilize. And says I was going, did I answer your question?
Pretty well, yes. Yeah. When they're all starting to get competitive, they're all looking at their bottom line and they're marginalizing their line, as you say. But they jump up and then they realize there aren't that many people refinancing and not many people taking mortgages out. So they're all fighting for that dollar. Yeah.
And what happens there too is you, again, they want to retain the servicing on this, right? So they, a true, when one of the bigger banks securitizes the mortgage and sells them on the secondary market, they're counting on that loan staying in place for like 24 to 28 months before they turn a profit. Okay, so it's a big risk when we're in a volatile market like this, and we can predict, historically speaking, we can predict the future based off of the past and how refis would come. Let's also had a question about ARMs. So right now you're not seeing a huge appetite for ARMs in the secondary market. What I mean by that is Fannie and Freddie are not supplementing ARMs, they're not buying a lot of them. So it's not as strong as it was. When I got in the mortgage industry in the early 2000s, everything I sold was an ARM rate. And it's because it was a point to 2 points better than what a 30-year fixed rate was. ARMs are great products as long as you are educated on what it means and how it works. And we do a lot of jumbo, or a lot of our jumbo products are ARMs, because we're able to secure really solid rates on a 10-1 ARM. And you guys know the stats. How often does someone sell or move out of their house? 10 years is a long time. That might as well be a 30-year fixed. ARMs have a bad reputation from the old 3-2-1 buy downs, where builders were putting communities together using their mortgage company, buying that rate down 3% and not escrowing taxes and escrowing taxes and insurance. And then a year later, it all hits. And then the loan was going to foreclosure. So that was a lack of education there. I had a front row seat to 08. So that's just some of the stuff we learned on the way through.
Yeah, that's awesome. Adam, I saw you asked about where we can find this information, and I do have a list of my sources. Chris, do you have a favorite spot that you go to?
Yeah, I get the majority of my stuff off of MBS Highway.
Okay.
Barry Habib is the guy who runs that site. And, you know, I'm a king of R&D. I rip off and duplicate. So if I see something that works really well, I'm going to use it. And that's where I got these slides from today. So
same. Awesome. Well, I'm going to put, I really like Adam, and I think I've shared this with you, but I really like mortgagenewsdaily.com. They have a really good, probably not as technical possibly as MBS Highway, but I think they do a really good job of taking complicated data and kind of breaking it down and kind of rewriting articles that are easy to read. So, and you can sign up for a daily email from them, which I found to be a good way to stay in touch with that. So
I agree.
Okay, awesome. Well, Chris, thank you again. I think you're going to stick around for at least a few more minutes. So if somebody has another question or thinks of something else and feels like Chris is the best person to answer it, feel free to call him out in the chat or unmute and call it out. So I'm going to go ahead and jump right in to the real estate market numbers here. As Chris was saying, due to the household formation conversation, the ironic thing about what we're hearing in the news is that inventory and months of supply still remain near all-time lows across the country. So the media is grabbing on to the percentage of change and really loving those big numbers and the swings. So we're going to go through those, but I think just like Chris said, the best way to calm our clients is really to talk to them about what the actual numbers are and how it compares to just a couple years ago, instead of always comparing the numbers to last year, which last year was an extreme anomaly that, you know, we're probably not going to see very many times, where 2020 and 2021, really the second half of 2020 and 2021 happened. And so jumping right in, I found realtor.com to actually have really good graphics. But newly listed homes are up 4.5% in June compared to last year. But the big thing that you want to look at, though, is look at the trend lines in terms of what was happening before. And this is the first time this year that new listings have really been up above 2017, 18, or 19. And so that's something to keep an eye on, whether that trend continues or not. We had so few listings coming on at the beginning of this year, though. We're still in a lot of markets behind. The active listings, again, this is the one that I think most clearly shows us that our perception of just comparing last year to this year is so off. in terms of what normal reality is. Look at these lines here up here for active listing count in 17, 18, 19, and 20 compared to where we are today. So the media jumps on the fact that we have an 18.7 year over year increase, 18.7%, and this is nationally. But look at, we're still at like 50% of where we typically are in June compared to 17, 18, and 19. So we have a very long ways to go before, in my opinion, we're in any kind of major trouble. Pending listings were down, but again, still well above 17 to 19. I think one of the questions on pending listings, and I'm not sure exactly how they're calculated, so this is a little bit of ignorance on my part with regards to this number. And Chris, if you know, feel free to jump in. But I think pending sales also include new construction. And I know the length of time, and I'm sure for those of you on the call that are agents, the length of time from going into contract on a hole in the ground until the time that you're actually getting the keys is a lot longer than historically it is. So the number of properties in contract could be getting bolstered in some ways by that.
Yeah, it's literally a piece of dirt is considered under contract.
Yeah.
Those were the numbers we got the other day.
If
Yeah.
those are staying in contract for 18 months instead of 12,
Yeah.
that could inflate that number. I know for those of you that have been on here before, you know that I think it's valuable, even though I know you're not all in Columbus, just to talk about the fact that basically real estate is local. And so this is the overall Columbus market in terms of looking at what's available versus what's pending and new listings. And when we look at June of this year in Columbus, Ohio, the new listings were down 4%. Active listings were up 36.5%, which sounds enormous, but last year we only had 2,000 houses on the market and we sell 40,000 a year. The solds were down 11.9%, but again, my opinion is a big chunk of that is due to new construction not closing. And then also the fact that new listings were down so much at the beginning of the year, but again, pending's up. And you see that in the year-to-date numbers down there. So new listings year-to-date down 1.8%, active listings, which basically mirrors the what's happening today, are up 21%, and then sold's down 5%, pending's down 1%. So these are the numbers. I think for those of you that are agents, just keeping in mind that, you know, fewer solds, especially with still rising number of agents, can sometimes, will always mean less commissions getting paid out. But here's the other thing to look at. Average days on market still down 11.8%. Now, I believe they based those off of the sold numbers. So obviously what's selling in June was actually going into contract in May, which that was kind of right when the market turned. So we'll continue to keep an eye on that. Days on market down 4 days. So again, I think that's based on sold data. So we'll see what continues to happen. But when you see average days on market still going down compared to last year and well below what it was in previous years. Median list price certainly has yet to take a hit. That's a pretty direct increase in trend line. As Chris said earlier, I think most of us expect that to begin to level off. I think we'll probably start to see that in the, and I don't know why this is looking at May. So I guess we didn't get the updated June in there. Average sales price in Central Ohio up 12.3%. Again, sold data is usually somewhat of a lagging indicator, as I've mentioned a little bit or a few times today. But I still think, you know, year to date or even month to date so far in July, we're still seeing those both active property prices as well as average sold prices increasing. So definitely not a sign of what we're seeing even in other markets, and certainly not what the conversation is nationally. Price reductions though, again, they are definitely a trend now compared to, you know, at the beginning of the year, we saw them going up and inching up a little bit. Definitely now it's an absolute trend, but still when we put it next to 17, 18, and 19, I mean, this is just a real estate market. Like what we've been in over the last 2 years hasn't really been reality. And so, you know, if this now blows past what we saw in 17, 18, and 19, then we can start to worry. But as long as we start to see that trend line start to flatten out a little bit, we've really just returned to a little bit more of a balanced market. But still, even in 17, 18, and 19, in our market, at least, it was a fairly strong seller's market still. This was an interesting stat page, and I don't want to go too deep into the numbers here, but this is kind of picking the top 50 markets, and this was off of realtor.com. I just grabbed the top, I think there's 18 on here that also included Columbus. But the interesting thing is look at the median list price. The median list price in almost all of these markets was up. So even in Austin, which has garnered a ton of headlines over the last few weeks for sure, as being a place that the active listings have gone up 144%. So that's like the number that they choose to talk about. And they also like to talk about the fact that there are a bunch of price reductions, but 24% of people reduced their price, but their list average or median list price was still 18.7% higher than it was last year. So in order to actually go to a place where housing prices were declining, I mean, you would have to be doing 20% price reductions, which I'm assuming. Emily, are you in Austin yet? Are you still on here? Emily Snyder just moved to Austin or is in the process of it. But anyways, I was curious if
Sorry, Troy, I'm here.
are you seeing anything locally in terms of prices and how far they're reducing?
Well, interestingly, I'm sitting here in Columbus. We're not leaving till the end of the week. However, I did have the opportunity to hop on a call with Keller Williams Citywide down in Austin last week for their monthly team meeting. And what they were saying is they're sitting on about 2.8 months of inventory right now. And they are starting to see some minor price reductions, not huge, but definitely more inventory than we have. And their market was every bit as hot as ours was until about the beginning of June.
Yeah, but they've seen I mean, their average sales price is 620. They used to be, if we look down here at Columbus, we're at 350. We used to be pretty equal to each other in terms of prices and all that stuff. So they've exploded in a way, and their appreciation's been even significantly higher than what we had here.
Well,
So
I mean, look at the house I bought there. We sold our house, our 2,500 square foot house on half an acre in Upper Arlington, which we bought 3 years ago for $470. We sold it for $711, and bought a 2,600 square foot house on 0.2 acres, ouch, in an HOA for $685. So yeah, their appreciation is huge. And every house we looked at was just, we felt, I mean, sitting on a postage stamp of a lot. If we wanted the same house in the same caliber of school district there, we would have been looking in the $1 million range.
yeah, so about a 30% difference in pricing.
Yeah.
Yeah, and like I said, 10 years ago, we were, I think, on a pretty level playing field. So yeah, interest rates, as Chris mentioned, well, I don't know that he specifically mentioned it, but interest rates have definitely flattened out after kind of increasing pretty quickly, very quickly over the first 3 or 4 months of this year. They pretty much bounced between 5.5% and 6% over the last couple of months. We've talked a lot about the impact on your payment, but I think this is a good thing to talk about. Now, Chris kind of lets the air out of my balloon with this comment, because of truly a recession has typically resulted in lower interest rates than we might be moving towards this not mattering as much. But my comment on that in terms of being the market expert is we do know what interest rates are today. And if Chris is wrong and other people who say they're going to go up to 10% are right, the worst, you're locked in. The worst thing that happens is interest rates fall back and you just refinance. So to Chris's point, there's some pricing conversations that loan officers have that become necessary in terms of what rates they can offer. But at the end of the day, as an agent or a consumer, my goal is to lock in the known. And then we're either in a great spot if they go up, or if they go down, then we can always refinance. But waiting around for lower or higher rates just doesn't make sense, in my opinion. We have seen that largest increase. This is one thing that I thought was interesting. Purchase applications were down, have been down, but not a ton compared to what you would think that the news media was talking about. So it'll be interesting to see as rates have gone up. I also know, just anecdotally for me, a lot of people are on vacation right now. I was just on vacation. That's why we're a week later than normal. And so it'll be interesting to see as things start to level out, people start to get back to their normal routines. I know, for example, I have an Airbnb, and it's been like a week and a half since we've had any bookings. And literally today we got 3. So there must have been a lot of people on vacation last week, which made me happy. So a little bit about inflation. There's the 2 types of inflation, which we talked about last month. That's continued to go up. The new numbers that came out last week were 9.1% for total inflation, and then core inflation, which excludes food and energy, which I'd love for them to show me the people that live without food and energy, went down a little bit last month. But overall, we're continuing to see inflation. I think most experts expect inflation to continue moving in the upward direction for the next several months. And again, like Chris said, that's having a very big impact on car loan rates, credit card rates, all of those short-term rates. But it does not seem to be having nearly the impact on mortgage rates. Last week, inflation was higher than expected, and mortgage rates pretty much stayed the same. So make sure, that's another way. I think it's one of the biggest misconceptions that consumers have, is that the Fed funds rate, which is what they talk about raising all the time, what the Federal Reserve raises, is not the same as mortgage rates. And if you can just understand that nuanced difference, you put yourself in probably the 90th percentile in terms of agents that can just have that conversation. And so with some clients, they're not going to care about that at all. But if you're talking to somebody who is a high level business person, being able to explain that and have that conversation could be the edge that you need to grab the listing. This was a stat that I think I might have talked about last week, or last month, that I didn't have the graphic for. But this is what happened locally here in Columbus during the last period of very high inflation. And so again, to Chris's point about recessions don't mean depreciation. This was the last time that we had a highly inflationary environment, and also even record high interest rates. And look what happened with appreciation and housing. Appreciation went up. So if you look at the years leading up to the high inflation, you can see that prices were still rising, but then the highest inflationary environments, we actually saw housing prices go up. And ironically enough, the number of sales, and this is obviously just unique to Columbus, Ohio, but the number of sales actually peaked during 1979 and 1980 during some of the highest interest rate environments. So this idea that just because there's a recession, or just because we have high inflation, that means doom and gloom for the real estate market. Again, we don't know. None of us have a crystal ball, but we do have history to lean back on. And I think that period of time is the most relevant period of time to look at to try to make educated guesses on what's going to happen in our market. And I thought that was a very, very interesting number. So I think the biggest question that people have is, will this be another 2008? I think you probably know what my opinion is, but I wanted to quickly go through a few of those specific reasons why I think that it's not going to be. So most homeowners have massive amounts of equity. Rental rates have increased with almost the same intensity as purchase rates have. And so until it becomes way more expensive to buy than to rent, I think you're going to continue to see people moving in the purchase direction. The types of loans, which we talked about earlier, are definitely stronger than they were in the early and mid 2000s, when over 20% of all mortgages were being given to subprime borrowers. And then I've mentioned it already, but inventories remain at historic lows. So homeowner equity, over 10% of this graph I thought was kind of cool. So this is in Q1 of 2022, the red bars. There were 10% of people that had 50 to 55% equity, another 9.5%, et cetera, et cetera. And you can go down here. Very few people have less than 10 to 15, 20% of equity. And actually, this chart doesn't show it, but there's 44.9% of people that have over 50% equity in their homes as of the beginning of this year, which was very different than in 2008. Affordability continues to be an issue like we talked about. And this is your average home prices as a percentage of median household income. So you can see we kind of peaked to a degree in 2007, 2008, and we've actually increased above that. Now, that being said, I don't have anything in here, but there is data coming out that wages are going up. And so we'll see at what rate they go up. But I think the last check was over 5% per year, which obviously is a lot less than the 20% housing prices have increased. But I think as long as we see that trend continue, that could also bring us out of this. Affordability is local, which we talked about before. This was the new one that I found. Where did I find this? On CoreLogic. But rents have increased by 14% nationwide, and that's in all categories. So single family, low tier, mid tier, and high tier. And so again, when we talk about affordability, it's great that people are saying housing, purchase housing is unaffordable, but the reality is, what's the alternative? So unless people are moving back in with mom and dad, there's just not a lot of places to go. So that's what this data is showing here. This was another thing I wanted. I've got so much information, like I said, so sorry I'm bombarding you guys. Average credit score though of rate lock, this orange line right here is the average credit score over, let's see, what does this go back to, 2018? And you can see that it's above 720. So the average rate lock on a purchase has a credit score above 720. And so, again, we're giving loans to people differently than we were in 2006, 2007. And then the last numbers here are regarding inventory. This was really surprising to me. If you go back in Columbus, Ohio to 2004 through 2008, you see our average number of new listings per year was between basically 45 and 51, essentially, up until the year 2008. But look over here at the sales. We were only selling about 50% of the inventory that was coming on the market. If we jump up here to 2017, we were only putting on between 36 and 40,000 new listings, and we were selling almost all of them. We were selling pretty much 90% of what we were putting on the market. So we're just, none of the data, at least I can speak to Columbus, and I think it holds true pretty much throughout the United States, but none of the data supports the idea that anything is like 2008, except for two things. Number one, interest rates are rising, which they were from 2004 to 2006. And then also the fact that we've had appreciation and we're going into a recession. Those are the only two things that are even the same. All the underlying data is completely different, which leads me and many others to believe that the outcome is not likely to be the same. So one of my favorite analogies, this is from David Green on Bigger Pockets. Jenny called out Chris's analogy about marrying the house and dating the rate. This is one of my favorites. If you're driving at 120 miles an hour in a speed zone of 65 and you slow down to 100 miles per hour, are you going too slow? I just really believe that we're slowing down, but that doesn't mean that we're crashing or that we're still following the rules. here's my sources. Again, Mortgage News Daily, Realtor.com, Trend Graphics. A lot of the affordability data comes from Black Knight. And it looks like my computer's about to die, so it's perfect timing. Anybody have any other questions at all for me?
Troy, you did an awesome job. So thank you for doing this every single month. It's so much value. I just have a quick question for you, and I'm just thinking of this as an idea. If the average home has over 50% equity right now in their house, think about the homeowners that, or even your past clients that maybe they're not looking to buy. Are you reaching out to any of your clients and saying, hey, let's use your money to go make you more money right now? Or have you heard of any agents doing that? Because why let it sit there when it could be making you more money?
Yeah, yes. The answer is yes. And I think somebody mentioned earlier about the stigma attached to adjustable rate mortgages. And I think the same stigma is attached to home equity lines of credit.
I agree.
And so that is definitely a big thing. And I know I didn't include it. I already felt like I had too many numbers. But there are numbers out that the amount of tapped equity, meaning in 2004, 5, 6, everybody was getting a home equity line of credit. And you're not seeing people do it. So the short answer is I have not done it. The interesting comment around that, though, is I did talk to somebody about 7 months ago about financing or lending on some rental, some investment stuff I was working on. And he reached out to me last week and he was like, hey, I really wish that I would have given you my money last fall because I put it in the market and I've lost 15% on my money. But are you still, do you still have any projects going on right now? And so I would say to you that definitely that's an opportunity. And I think especially with I think the only challenge that we're probably going to have with that, Dana, is that home equity lines are based off of that Fed funds rate. And so the cost of borrowing money is definitely in that manner is going to get a lot more expensive over the next year or two. And so that could be a little bit of an inhibitor for some people. But I think the advantage that you're going to have if you do have a lot of equity is that, and Chris didn't get into this, and I'm jumping into a whole new pond here, but liquidity has gone down. A lot of the big hedge funds had a lot of money in crypto, and crypto has tanked. And so there are a lot of what they call, this is really getting in the weeds, but non-QM lenders, like people that loan on non-conforming or not normal types of lending. So like hard money lenders, a lot of them use money from those types of hedge funds, and those hedge funds don't have nearly as much cash as they did 6 months ago. And so I do think there is an opportunity for our clients who have massive amounts of equity to leverage that equity and make some good returns on it.
Awesome. Thank you. Great job.
Anybody else have any questions? I'm going to try to find a plug here. Sorry, this is super unprofessional, but so my computer doesn't die. No? All right. Well, if nobody else has anything, definitely feel free to email me or call me, and I'm happy to send you the slides. See you guys.
Thanks.